If you had $100 a year ago, it feels the same today. But its purchasing power has changed. Due to inflation, that $100 now buys less. Recent inflation rates hover around 3.5% to 4.2%. Welcome to the Science of Investment. I'm Nicholas, your host today. Today, we'll explore inflation's role in devaluing your wealth. We'll discuss how to protect your hard work using scientific investing strategies. Get your coffee ready, and let's dive into the data. To understand inflation, we need to set aside politics. It's a straightforward relationship between currency supply and available goods. Imagine two sides of a scale. On one side, we have money. On the other, goods and services. When money supply grows too quickly, the value of each dollar decreases. Picture adding water to your coffee. Continuous dilution makes it weaker. Economists use the Consumer Price Index, or CPI, to track this dilution. They monitor various prices, from groceries to rent. But as an investor, you must grasp two types of inflation: headline and core. Headline inflation covers everything, including fluctuating food and energy prices. But core inflation focuses on the stable, underlying trends of the economy. What's concerning now is that core inflation remains high. This has direct implications for your income. Now let's discuss a common psychological trap in finance known as the money illusion. Imagine receiving a 3% raise from your boss. You feel great. But if inflation is 4%, that raises your nominal income but reduces your real income. In reality, you faced a pay cut of 1%. The formula is simple. Real income increase equals nominal raise subtracted by inflation rate. If your income lags behind inflation, your standard of living declines. Keeping money in a low-interest savings account guarantees purchasing power erosion. So, how can we combat this? It's crucial to understand asset allocation. To navigate inflation successfully, your investments must grow faster than inflation. We measure success using real yield, which is calculated with this formula. Real yield equals nominal return subtracted by inflation. Let's explore different assets and their yields under inflation. Cash usually yields near 0%. With 4% inflation, it results in a negative real yield of 4%. Bonds can offer a fixed 4.5% interest. If inflation is 3.5%, you only gain a 1% real yield. Equities or real assets, especially tech, show a fascinating trend. Companies with pricing power can raise prices without losing customers. This allows them to mitigate inflation effects. In high inflation times, investments flow to sectors that can maintain profit margins despite rising costs. Investing isn't based on luck. It's based on understanding economic principles. Recognizing inflation as the rate at which cash diminishes will reshape your strategy. Shift from merely saving money to acquiring assets immune to inflation. Here on the Science of Investment, we'll analyze data, charts, and company metrics to identify these protective assets. If you aim to build a strong, future-proof portfolio, join our community. Hit subscribe, and together, let's master the science of wealth. Until next time, remain analytical and stay warm. Inflation isn't merely an economic concept. It possesses real-world implications that resonate in our daily lives. When you encounter rising prices, remember that inflation acts as a silent thief, eroding the value of your earnings and savings. It's imperative to recognize that hesitating to act can result in lost opportunities for financial growth and security. Prepare to pivot from the comfort of traditional saving methods to embracing investment strategies that safeguard your wealth. By understanding the nuances of market trends and adopting a proactive investment outlook, you position yourself to weather inflationary storms effectively. Let's continue by discussing specific strategies for asset allocation. As we delve deeper into asset allocation strategies, one crucial aspect is diversification. Spreading your investments across various asset classes, stocks, bonds, real estate, and commodities, can reduce risk while maximizing potential returns. Consider that while equities may perform well in an inflationary environment, certain bonds, particularly those linked to inflation, can offer protection. Additionally, real estate often acts as a hedge against inflation, as property values and rents tend to rise with the cost of living. Such a diversified portfolio not only stabilizes returns, but also enhances growth prospects. While diversification serves as a cornerstone of risk management, it's equally important to understand the timing of your investments. Entering the market during specific economic cycles can significantly influence your returns. For instance, during periods of economic expansion, equities often thrive as consumer confidence surges. However, a downturn may prompt shifts toward more stable investments like bonds or commodities. Timing your entry and exit points may provide enhanced security against the unpredictability of inflation. Assessing market indicators closely will grant you the insight needed to make informed decisions that shape your financial future positively. By remaining vigilant and flexible in your strategy, you can protect and potentially grow your assets even amidst the challenges posed by inflation. Furthermore, consider incorporating sector rotation into your investment strategy. This involves shifting your focus among different industry sectors based on economic cycles. For example, during times when inflation rises, sectors like energy and consumer staples tend to perform better as they provide essential goods and services. Conversely, technology and discretionary sectors may struggle to maintain growth once inflation pressures mount. By recognizing these trends and adapting your portfolio accordingly, you can take advantage of prevailing market conditions while safeguarding your investments against inflation. Embracing this flexibility helps ensure your assets remain robust even amidst shifting economic landscapes. As we explore these strategies, let's not overlook the power of education in investing. Becoming financially literate equips you to distinguish between sound investment choices and fleeting trends. A proactive approach involves not just absorbing this information, but actively engaging with it. Attend webinars, read investment literature, and join discussion forums that can expand your understanding and refine your strategy. Networking with like-minded individuals can provide fresh insights and diversify your perspective. Remember, investing is not merely a hobby, it's a commitment to your financial future, and investing in your knowledge is as crucial as investing in your assets. So prioritize learning and stay ahead of the curve. Moreover, it's important to keep a watchful eye on macroeconomic indicators that can signal upcoming changes in the investment landscape. Interest rates, for instance, move in tandem with inflation and have ramifications for various asset classes. When central banks adjust interest rates in response to inflation, borrowing costs fluctuate, impacting consumer spending and business investment. This environment compels investors to remain agile, responding swiftly to shifts in policy and market conditions. Additionally, geopolitical events can also create ripple effects through supply chains, further complicating the investment strategy. Understanding these dynamics equips you to make smarter, more informed decisions that protect your financial health. As we continue our exploration of these investment strategies, let's discuss the importance of an emergency fund. This financial buffer provides security in times of uncertainty, enabling you to avoid liquidating investments during market downturns. By having cash on hand, you can navigate unexpected expenses without jeopardizing your long-term growth potential. In conclusion, navigating inflation requires a strategic approach that encompasses diversification, education, and financial literacy. By staying informed and adapting your investment strategy accordingly, you can effectively protect your wealth and thrive in an ever-changing economic landscape. Remember, mastering the science of investment is key to building a secure financial future.